Everyone in construction has to pay insurance, but what if you could lower your insurance costs, be more effective at managing and controlling risk, and even potentially boosting your personal wealth? These are some of the benefits of setting up your own captive insurance company. My guest today is Wesley Sierk. He is the president and lead strategist at Risk Management Advisors, and he's an expert in the implementation, design, and management of captive insurance. And this episode of Construction Genius is all about everything involved with captive insurance. It's not for everyone. It's not for companies that have struggles with their safety records, for instance, and it's not for companies that are relatively small and don't have a ton of insurance premium that they're paying out. But it is for companies that are established and that are growing and that are looking to do those three things: manage their risk, save on costs, and also perhaps boost their personal wealth. So listen to this episode very carefully because it'll give you an overview of captive insurance, the different types of captive insurance companies that you can set up, obstacles to getting started with captive insurance, the one reason why you shouldn't get into captive insurance, and more than 3 or 4 reasons why you should. Wesley is very generous with his time. If you check out the links in the show notes, there's tons of resources to Wesley's website, as well as books that he's published, so you can get to know this area of insurance known as captive insurance. Some of you may be very familiar with it, I'm sure, but this will give you a refresher on it. Or if you are already involved in a group captive, it may give you a couple of different reasons why you could look at a single parent captive. So all those things are covered in this interview. And so just dive right in, enjoy it. It's a little longer than our usual interview, but I think it's longer because the content is excellent and it's important to understand this opportunity and this option for you in terms of how you're spending your insurance dollars. Thanks for listening to Construction Genius. Feel free to share this with other people that you think would benefit from it. Give us a rating or a review wherever you get your podcasts, and enjoy my discussion with Wesley. This is Eric Anderton, and you're listening to Construction Genius, a leadership masterclass. Thomas Edison said that genius is 1% inspiration and 99% perspiration. If you're a construction leader, you know all about the perspiration, and this show is all about the 1% inspiration that you can add to your hard work to help you to improve your leadership. Wesley, welcome to Construction Genius.
Oh, thank you, Eric.
Tell me, how long have you been working in the insurance industry and around the insurance industry?
I started in the insurance industry in 1993.
Yep.
And right out of college. And went into the life insurance business, actually. But instead of doing like the kitchen table sales, I was doing more corporate. So I did qualified, non-qualified plans. So pretty much everything we did revolved around taxes in some way, shape, or form for business owners.
I see.
And then around 2000, I discovered captive insurance companies. And my first reaction, because at that point I was doing deferred comp, my first reaction is, wow, this is a much better alternative to deferred comp.
Well, let me just ask you real quick. Your conviction is that there's something not quite right with the way insurance is sold and the way it serves the people who are purchasing insurance. And can you tell me a little bit about that, please?
So when I switched from life insurance over to property casualty, I was trying to figure out, because I think I'm a researcher by nature, and I was trying to figure out how this property casualty liability workers' comp marketplace worked. And unlike the life insurance industry, where you could have 7 brokers all go out to different companies or the same companies and get quotes, the property casualty marketplace is completely different. You have one broker that then goes out to the marketplace for you. Right. So you can't get independent quotes from different people from the same companies, unlike life insurance. Now, in the olden days, and I would say pre, 85,
Right.
86, somewhere in there, insurance companies did a really good job of differentiating themselves by their policy language. And after that, in order to save money, the insurance industry really commoditized itself, where they're all using the same basic forms and they're competing on price. And a lot of business owners would pay more for a policy that covers more.
Right.
Well, most of the policies written that you see at the bottom of the policy, it says ISO, like for general liability, ISO CG 00001 or 2 or 6 or whatever. But ISO stands for the Insurance Service Office.
Right.
So that's a company that writes policies for the insurance companies, and they're funded by the insurance companies. So if you think about it, if you have one company that writes policies and they're paid for 100% by, or nearly 100% by, the insurance companies that they write policies for, whose favor do you think they're going to write the policies in?
Sure.
The person buying it or the company that is actually paying their salaries? So, fundamentally, I think that's the one issue with the insurance industry is it's really a contract of adhesion. You get your contract, and in, I would say, pre-85, maybe up to 89 or 90, you would get a policy that was 30 pages long, and it would be 25 pages of what's included and 5 pages of what's excluded. Now that same 30-page policy will have 5 pages of what's included and 25 pages of exclusions.
So from your perspective, then, the insurance industry is serving more of the insurance companies as opposed to the folks who are purchasing the insurance.
Exactly. Okay. And then it gets exacerbated by only having one broker. So you can't really get independent. Who knows what policies are actually being shown. And I'll tell you, there are some phenomenal brokers out there, and we do a lot of work with brokers because we don't sell product. But then you have, so the insurance, if you think globally, this is more macro, but insurance companies are publicly traded companies.
Right.
So they have to pay a dividend out to the shareholders.
Mm-hmm.
And no one begrudges them making a profit. That's not the point of this. But they how they make money is they take in premiums, and they have their capital and surplus and reserves is invested. Now, most of the investments are in long-term secure bonds, government bonds, corporate bonds, state bonds, some muni bonds, something like that. Well, over the past, until recently, the premiums have been going down and down and down. We were in a very soft market for a 10-year period of time.
Mm-hmm.
And so their premiums are going down, and interest rates have also been going down. So they had less money coming in the door.
Right.
Well, what happens is then they have expenses, and those expenses are claims, staff, reinsurance. So in order to pay out the dividends, what the insurance industry has been doing is buying less and less reinsurance. So they're taking more risk on themselves. Mm-hmm. And they were lucky they didn't have any floods in Central Europe or hurricanes or other natural disasters. But when COVID hit and they had to give back money because states require them to give back money, and they had claims that came out, the capital and surplus of the insurance industry as a whole has been decimated. So it's going to take them, they project, I read stuff all the time, but they're projecting they'll probably have to increase rates 30 to 40% for up to 7 years to make up for where they were before the pandemic.
And so that's going to hit everyone, even if you're a really good risk.
Correct. Everyone has to pay.
Right. So what in your mind then is one solution to this dilemma that companies find themselves in, where, again, we're not begrudging people profits, but we want to manage, we're responsible as, owners of our business to manage our money well and to manage our risk well. What's one solution that you found to be effective for construction companies?
Well, I mean, we're here to talk about captive insurance companies.
Let's talk about it.
That's a wonderful solution for the right businesses. And
okay, I know that many of the folks listening here have heard of captives, but for the benefit of everyone, let's just clear the decks real quick. Give me a clear definition of what is a captive insurance company.
It's an insurance company that a business sets up to insure their own risk. So it's a licensed, regulated insurance company. But instead of buying from the AIG, Zurichs, Liberties of the world, you actually have your own insurance company. And that could take many different forms.
Right.
There's a whole spectrum of risk, from a risk retention group where, you get a group of people all together that are all paying capital and surplus, and then they all pay their premiums. And then when little claims come in, they pay their own. But when big claims come in, it's spread amongst a bunch of people.
Right.
That's on one spectrum, all the way to the other end, which is a single parent captive.
Right.
Where the business owner pays the premium to their own insurance company. They go out and buy reinsurance, and they're no different than the AIGs, Liberties, or Zurichs.
Right. Okay. So before we dive into the different types of captive insurance companies, the different structures, can you give me 3 clear reasons why I, as a construction company owner, would want to get involved with captive insurance? Take that approach.
1, you control the premiums.
Okay.
So they're a lot with insurance in the traditional market. It's kind of a good news, bad news.
Right.
At the end of the year, they come to you and they're like, "Hey, good news, you didn't have any claims." But the bad news, Eric, is everyone else had claims in your industry. So now your rates are going up.
Right.
Or they come to you and they're like, "Hey, bad news, you had bad claims. So now your rates are going up."
Right.
And that's the bottom line, is the rates are always going up.
Right.
That's the first thing. You take the ups and downs, the hard and soft markets out of it, and you're paying yourself what the actuaries tell you need to cover as far as your risk.
Okay.
You also get control over claims, because routinely in my career, and I'm not saying that all companies are bad by any means, but I'm just saying in my career, I've seen insurance companies routinely settle on things they shouldn't settle on and not pay claims that they should.
Tell me more about that. So talk about that a little bit. And how would that affect me as the construction company owner?
Well, if they're paying the claims or not paying the claims, which one?
Take either one.
Okay. So take workers' comp as an example.
Excellent.
We got into captives by doing our own workers' comp. So that's an area that I have a lot of knowledge. But with workers' comp, it's a 50% margin business. So if a construction company pays $1 million a year in premium for their workers' comp, the insurance company expects to pay out $500,000.
Okay.
If they pay out more, and it doesn't even mean that they paid it out, they just set the reserves higher to say, well, we think we will have to pay out $800,000. They may have only paid out $5, but by setting those reserves, they actually say, well, we're going to pay out $300,000 more than we thought. So we get to collect an extra $100,000 each year for the next 3 years to make up for that. And it doesn't matter where you go. That's how the experience mod works. That experience mod follows you wherever you go.
Well, hold on a second. I thought, and forgive my ignorance here, I thought the X mod was based on upon the safety record of the construction company, or the claims that the construction company makes.
It is, but they routinely set claims higher because insurance companies have to pay taxes on their net income.
Right.
This is off topic, but let's talk about how an insurance company pays taxes.
No, it's good. Let's talk about it.
They take in premium dollars as taxable income, but they get a reserve for they get a deduction for any claims they have,
right,
expenses they have, what the actuary tells them they need to keep in reserves, and then this gray area bucket called incurred but not reported.
Right.
That's just their way of saying we have claims, we just don't know when they're going to be reported to us.
Yeah.
So a company can take in $1 billion in premium and pay out $100 million in claims, and if they set the reserves at 400,000, then that means they're paying taxable income on $500 million.
Right.
Insurance companies paying taxes on 500 million. But if they set those reserves at 600, 700, 800,000, by setting the reserves higher, it allows them to shrink their taxable income, so they kick that can down the road.
Right.
I mean, I'm sure all of your listeners that run construction companies can look at their workers' comp claim report,
Yep,
and find claims where the people are already back to work and they're still reserved claim amounts on their report.
I see. Okay.
That's what I'm saying. They, on that example with the $1 million
Sure.
construction company workers' comp, they just say, hey, this back injury, instead of being $75,000, we're going to set that at $300,000 because we don't know if it's going to be a really bad one or not.
I see.
So there's an incentive for them to set reserves higher.
So they've set the reserves based on a claim coming in.
Correct.
And they set it higher so that they'll have less taxable income.
Exactly.
And then that hits also the amount of money the construction company has to pay down the road because their X mod goes up based on that reserve.
Correct. Exactly. Yep. You're exactly getting it. And then typically they'll hold these claims open until new claims come in, because then they can move that reserve from one claim to the other claim and not have to pay taxes. There's in my beginning, in my research, there was a fascinating book by Andrew Tobias. I don't know if you remember who he was. I think it was written in 1980, but he was like the Susie Orman of his time. And the book is called The Invisible Bankers. And it's all about the insurance industry and how they pay taxes and how they reserve stuff. And it's a fascinating book. And that's when I'm like, I want to be an insurance company.
That's interesting. The link will be in the show notes to the Amazon book where you can get it, just so you guys know. I just found it. Link will be in the show notes. Okay, so that is, as you can tell, dear audience, and Wesley, I'm learning as we go here. So I just learned something today. And now, to any of my dear insurance friends who may be listening here, who are with insurance companies, that sounds a little bit of like a hose job to me, Wesley. Am I hearing that right?
It can be.
Okay.
Now, I will say that insurance works on the law of large numbers.
Sure.
So, like auto insurance, we have our own insurance company, but I would never, ever decide to write my own auto insurance because I know, I have a 16-year-old son that's going for his driver's license next week. I have, my wife, has historically been in accidents. So why would I want to take on $1 million worth of risk to save $3,700 a year? It's penny wise and pound foolish. Right. In the same way that when you look at your overall insurance portfolio, as a construction business or any business, there are certain policies where you're going to be like, I don't want to take this risk. I'll pay $7,000 for property insurance instead of taking that risk myself. So there are insurances you should keep in the traditional market. Okay, so let's talk about it. There is also another part that I'd like to talk about, if you can touch on it as far as a captive's concerned. You've talked about how with a captive you can control your claims, you can have more control over your costs. If I'm an insurance company, I'm taking my premiums and the excess stuff, I'm investing it like you were saying. Is there a potential for someone involved in a captive insurance to boost their own personal wealth through a captive? Yeah, well, we talked about how insurance company taxation works. So that's like a regular insurance company. So I don't know in your previous episodes if you've gone through like all corporations start out as C corps unless they take an S election. No, we haven't done that. So feel free to go ahead. Yep. So, with a corporation, all corporations start out when you form them and get your tax ID as a C corp, but you can take an S election on that to be taxed as a partnership or a pass-through. So all insurance companies start out as under 831A, which is what I was going through, like the general taxation of insurance company. So a captive can be an 831A, and we have a lot of those that are 831As, especially in the construction industry.
Mm-hmm.
Now, you can take an 831B election, and once you take that election, the limit for your premium and on an annual basis is currently $2.4 million per year, and it adjusts with inflation. But if you take that election, all your premium is tax-free to the insurance company. All your underwriting profit is tax-free to the insurance company. You only pay taxes on realized investment earnings.
Okay.
So let's say you paid premiums of $2 million, and it never happens, but let's just say you had no claims. That $2 million and it grew at 5%, then that's $100,000. But not all 5% would be realized. It may be 50% realized and 50% not realized. You not realized till you sell off the stock or mutual fund or whatever.
Mm-hmm.
So on the $50,000 of realized, you pay a 21% federal rate on that. So, you in essence, to make the math easy, you would have paid $2 million to cover yourself, to basically, supplement or replace the insurance you were buying anyway. And your taxes on that would be $10,000 federally.
Right.
So there's a tremendous ability to generate wealth, especially when you look at the claims, because if you're paying a couple $1 million a year and your claims are low, why wouldn't you do that? I was on the phone this morning with a contractor in New York, and they have labor law 240 and 241, which is horrible, one of the worst laws in the country. But their insurance spend is $1 million a month. So they're at $12 million a year. And we were going through their claims, and they've actually had some bad claims throughout the years. But since you have contractors on, this is a construction show, they'll understand this.
Yep.
But if you pay insurance today, your general liability policy today, and let's say that's $1 million for a $4 million policy.
Mm-hmm.
You pay the insurance company up front. It may take you 2 years to build it.
Right.
That's when you get your certificate of occupancy.
Sure.
Then that starts the clock for your products and completed operations.
Yeah.
So it's usually 10 years. Some are more, some are less. One's 15. Nevada just went to lifetime construction. Yeah. But let's say it's 10 years. Well, most people file, let's say it's a condo, they're going to file in year 9.5. Then it goes to court. In insurance companies, we talked about it before. There's I call it the 3 Ds: deny, delay, defend. That's what they do.
Right.
And then, so now you bought it, you waited 2 years, now you're 10-year statute of limitation, and then you're in court for 3 years from when you paid the insurance to when you actually would pay that $3 or $4 million out. It's 15 years.
Right.
So could that $1 million, if you paid it, even if you paid it to your own insurance company using, the rule of 72, let's just say it doubles every 7 years or
right.
8 years. Well, that, 1 becomes 2, 2 becomes 4 by the time the claim will actually come through. That's the way insurance companies do their pricing. It's really, for construction, they use full limit losses for their pricing.
Okay. So let's go back to this idea of setting up a captive. What is an approach that someone should take in terms of beginning to explore it, questions they should ask themselves if they want to figure out if a captive insurance approach is for them?
Probably where we start with the premiums that they're paying,
okay,
and the losses they have.
Okay.
So a really good litmus test is if you can remember the last time the insurance company paid out more in claims than you paid them in premium, you're probably not a good candidate. Okay. So if you pay $1 million and if you pay 500 and they're paying out $1 million, don't even look at it. Do that all day long.
Okay. That's simple then.
Yeah.
Okay.
If your claims,
so that's your claims percentage then, right?
Yeah, I would say the person that should look at it for sure is if their claims are 50% of their premiums. I'd say do that all day long. At least analyze it. And, if it's 60 to 75%, then, it may make sense. But you need somebody that knows what they're doing to do the analysis, because it's basically income, the premium minus the cost of running your insurance company minus any reinsurance you want to buy, because everyone wants to protect themselves. You don't want to go unlimited on your claims.
Okay.
You may take the first 100, 200, $1 million per claim.
Okay.
But as I'm saying it out loud, one thing I'm thinking about that derails a lot of this is, when it comes down to it, some business owners would just rather pay premiums,
right?
Not have to worry about it.
Tell me why that is.
Because they have so much hassle in running their business anyway, that they look at it like, you know what, I'd rather just pay the premium and not worry about it.
Right. Yep.
No, I was going to say, so if a business owner, construction company looks at their insurance and it bothers them,
right?
If they feel like they're getting the shaft,
right,
then that they should look at it. But if they're like, you know what, it costs a lot, they don't pay out anything, but at the end of the day, I'm protected, and I'd rather do that than worry about it, then they're not ideal.
Okay. There has to be, on the one hand, a sufficient good record of safety or a lack of claims as it relates to the amount of money a premium that you're paying. And then there also has to be a willingness to go through the process of either setting up a captive, a single parent captive, or getting involved in a group captive. Is that what I'm hearing?
Yeah.
In your opinion, because I know most of the folks that I know who are involved with captive insurance are involved in group captives. And so part of me says, well, what's the difference between a group captive then and just regular insurance? And I'm sure you can explain that. So in your experience, is a single parent captive the best way to go? What about a group captive? What are some different types of captives that are out there that someone should consider?
Great. A group captive is a bunch of people coming together.
Right.
And they're all sharing in each other's risk.
Right.
And everyone pays the premium, and then they pay a small amount. I mean, I just did an analysis between a group captive for somebody, and then now they're going to their own, they're going to a single parent captive because they outgrew the group captive.
Okay. So tell me then, this is just for my benefit. When they went into the group captive, what kind of revenue were they doing?
They were probably 35 million.
Okay. And what kind of premiums were they paying?
Yeah, when they started in the program, they were paying about $400,000 a year.
Okay.
And it worked great.
Right.
They took 50%. So the way group captives, if they're structured properly,
right?
Okay, the premium should be roughly equivalent to what they would be paying in the traditional market. And that's the way this was set up. And then from there, the group captive manager took about 30% to run it. They paid 13% in reinsurance, and it plugged away. They had to fund it with, $7,500, $10,000 in capital and surplus. But if they had good results, which they did, then they would credit a little bit back to the business.
Right.
But by crediting it back, it just meant that they asked for a little bit less as far as capital and collateral the following year.
Okay.
So now their premium has increased to, this year, it's $2.596 million. So you can see that's a huge payment. And I'll just pull it out. The cost, just the fixed administrative cost to run the captive for them, to be part of this group captive, is $859,000 of
that
the
2.5
of the 2.5 million.
Wow.
And 85,000 of that is state premium taxes.
Okay.
So that's a huge amount to be paying out for that. And they still, if everything went bad in that structure, they could still be charged $3.2 million on top of the $2.5 million.
Right.
So call that $6 million.
Right. At this point, then they're going to be moving over then to a single parent captive.
Correct.
What is going to be the main benefit for them from moving from the group captive to the single parent?
This is a program with Chubb. So Chubb is actually writing the coverage for them. And they're taking the first $500,000 of every claim up to $5.6 million total. And then they're completely off the hook. Okay. The total cost to do that entire program to Chubb is $652,000.
Okay.
So that to me is the big difference. They were paying $2.5 million in the group captive, and they had out of that, they're paying $800 and some thousand to the captive manager to run the program.
Yep. And
in this, they're paying their captive insurance the same amount of money that they were paying to the group, and they're paying $600,000, $652,000 out to Chubb for Chubb to issue the policy, handle the claims, and any claim under $500,000 is taken care of by the single parent captive, and then anything over $500,000 is taken by Chubb.
Okay.
So it's much more cost effective.
I see.
Long term.
And so if you're in a group captive, what is your experience in terms of how long does it take to transition from a group captive to a single parent captive, and what kind of, frankly put, hassles are involved with that?
Well, it's the hassle of creating where group captives are good, because think about it. If these people were in the traditional market at $2.5 million,
right?
They paid $2.5 million. They have no chance of getting anything back.
Right.
Where in this, the single parent captive, with the group captive, they pay that same amount of money. And at least if the claims are good, at least they have the ability to get some of the money back. So that's a positive.
Okay.
In a single parent captive, they're going to pay that same premium dollars, but there's the hassle of setting up that insurance company, which is what we do. We're basically a third party administrator to set up and run insurance companies for them, for people.
Right.
But that's it. There is that hassle. There's I was going to say possibility, but it's probably a probability that they will have to come up with additional capital to fund into their insurance company. But having said that, we're doing another one where we're taking them out of a group captive. This is in New York. And for the first time in my career, they're not the carrier, and that's with Arch, isn't asking for any collateral because their claims have been so good. Okay.
So we've got a couple of different sort of avenues we've been pursuing here. We've been talking about the logic of a captive insurance company, setting one up or participating in one in terms of managing and controlling risk, saving on insurance costs, and then that potential to boost your personal wealth as well. And we've also been talking about the benefits of a group captive versus setting up your own individual single parent captive. Would you recommend? Is there a one answer to this, or is it depends answer? Let's say I'm not in any kind of captive. I want to get into a captive. It sounds like if there's already a group captive that exists, it might be easier for me just to slot myself in with that one as opposed to going through that, what I'm perceiving at least is the hassle of setting up the single parent captive. Am I correct there? Am I hearing that right? If I want to dip my toe in the water, so to speak, of captive insurance?
Yeah, correct. But it also depends on how much your premium is.
Right.
Because that's where a captive manager can do the analysis and say, you know what, you're better off in a group captive. And these are the 3 group captives we'd recommend you to go into, and that have a great track record,
right,
that do things the right way. And because one of the reasons these people are leaving a group captive and coming over to their own single parent captive is, remember I said, if you want to, a correct group captive should be charging the same premium as a traditional market.
Yeah, I heard that.
What happens is, in order to get people in, many group captives, and by many, I'd put it over 75%, come in and start charging less money than the traditional market would charge. And that's the way to say, hey, you're going to be saving money right off the bat and you come in here. But over time, when people have bad claims because they just wanted people in there, what happens is the cost of the premiums go up to the time where these people are paying more in the group captive than they were just going out and buying insurance in the traditional market. So it creates a bunch of people leave, and it creates adverse selection. But by then you already have capital and surplus in there. You may have collateral, some letters of credit, and there's never a good time to just leave all your stuff there because they're not going to release that for 10, 15 years. So people just stay. But if they leave, then what's left is the good people leave and the bad people stay. And then they bring in more and more good people to offset that. And they eventually leave. And over time, I mean, that's why many of these group captives fail over time. I think it's a great place to go in, dip your toe in and see how you handle risk.
Right.
But as you get bigger, if your premiums are under $500,000, probably makes sense to go with a group captive. $500,000 to $1 million is probably 50-50. Over $1 million, I think it definitely. And we're doing, I'd say probably 60% of the captives we're doing, maybe more, are health insurance and workers' comp.
Right. So let's talk about that then as well. Then, just so that we're clear, just to restate it, in your view, under $500,000 group captive, $500,000 to $1 million. It depends. $1 million plus. Do the sole captive entity, the single parent captive.
Yeah.
Okay.
I think
so.
Good.
Let's talk about the types of insurance that should be in a captive and the types that shouldn't be in a captive. Let's just be crystal clear on that. And the reason I'm asking this is I'm assuming, is there ever a case where you found some companies that have certain parts of their insurance or their risk under a captive where it shouldn't be there? Have you ever found that before?
Yeah, where we have a security guard company where we created the captive and then they came to our captive managers because, so I set them up, I negotiated the reinsurance contract, but I wasn't there on the day-to-day operation. So they came to our client, or the client came to our senior managers who were all CPAs. And they said, our premium for our general liability has gone from $800,000 to $1.2 million. So we want to put it in the captive. So they did. And then because we do annual meetings with all of our clients, like board meetings where we have minutes and everything else. And they said, oh, when we doing this policy, I'm like, what? Why would you do that policy? And they're like, well, our premiums went up to $1.2 million. I'm like, yeah, it went up to $1.2 million because they paid out $7 million in the last 3 years on that policy.
Right.
So the fact that they even renewed it for you is crazy to me. As long as they're going to keep making this mistake, why would you take that risk at all?
Right.
So I said, hey, let's cancel this. Let's go back and get that.
Okay. So let's before we get into the types of insurance, I just want to make sure that there's that one benchmark that you did mention that I want to make sure that we bookmark. And that is, if I'm in a group captive, my rates should be in line with the rates that I would be paying outside of the captive.
Correct.
Yes. And so does that mean, in your opinion, if I am in a group captive right now, should I be evaluating those rates on an annual basis? Would you advise that?
Yeah, the broker should be doing that.
The broker should be. Okay. Excellent.
Doing that.
Okay. So then, all right. Now let's talk about what should be under the group captive or any kind of captive and what shouldn't be in the captive, please.
Yeah. When you look at your overall portfolio, there's certain pain points, and that's where I'm saying workers' comp and health insurance is a pain point for a lot of businesses.
Yes.
And, the Affordable Care Act, we went through the macroeconomic thing about insurance with medical insurance. The Affordable Care Act, remember, it used to be called the Patient Protection and Affordable Care Act.
Right.
They got rid of the Patient Protection. Now it's just the Affordable Care Act. And this isn't a Democrat or Republican thing. So don't take it that way. But the people who passed it the elected officials had no idea what they were doing.
Right.
None. because when they passed it, so part of the Affordable Care Act is insurance companies had to pay out 80% of their premiums in claims. Well, these are publicly traded companies. They have employees. They buy reinsurance. So the year it was passed, let's use this analogy. The year it was passed, United Healthcare did $110 billion in premium, and they paid out $60 billion in claims. So when the elected officials are like, oh, this is great. If they have to pay out 80% in claims, then that means the most that United Healthcare can charge when this thing passes is $72 billion.
Right.
So the way they did it, they said, oh, we'll pass this and everyone's going to get all these premium savings and it's going to be the greatest thing. When it passed, insurance companies were paying out about 160% of Medicare.
Right.
Now it's over 500 times, 500% of Medicare. Because what's happened is, and there were all those projections that said, oh, if this thing passes, hospitals will close, doctors are going to leave, no one's going to come into business. Well, that didn't come to be true, because what happened is the insurance companies are smart. If they have to live on a 20% margin, the only way they can grow that is by paying out more in claims. So insurance companies have been overpaying. They bought MRI facilities.
Right.
And they're now paying their own MRI facilities, where it used to be $1,200 for an MRI, and now it's $5,000 for an MRI. And they're paying it out because that increases the total grift from everybody.
Right.
And that's what I'm saying. They just didn't understand that the insurance industry is smart enough to figure out how to make money.
Right.
If you live on 20%, the only way you make more is to pay out more.
Yes.
But so that's where people's pain point is. So what we've done is we're doing a lot of captive insurance companies where people are just saying, I'm out, I'm going to become my own insurance company.
Right.
So like Blue Cross Blue Shield, they just pay their own ERIC insurance.
Right.
We write the document, we go out and get reinsurance. So you may take the first 25,000 of all your employees up to some amount, and it's usually the amount. If you use, let's say $1 million is the amount of businesses currently paying for their medical insurance. You usually buy a stop loss policy at 70% of what they're currently paying. So if you're paying $1 million, you may take the first 25,000 of every claim up to 700 total. So the whole thing is, can you buy reinsurance and run your own insurance company for less than that $300,000? And the answer is, in 99% of the time, yes.
So you're putting then workers' comp and health insurance under this captive entity.
Correct. General liability.
Right.
For contractors.
Yep.
We have a program for the first $5 million of excess.
Right.
For construction. That's a very hard level for people to get. Yep. Where their insurance company is only taking 20% of the potential risk, and then reinsurers are taking 80%. But if they don't have any claims, they have the ability to get up to 40% of that premium that they paid to their captive back. I mean, so it's a wonderful solution for these businesses.
So let's just summarize then where we've been so far in this conversation, Wesley. If I'm a construction company, I'm looking at my insurance premiums. For whatever reason, I'm discontent, which probably sums up 99.9% of the folks who are in construction. What are the first couple of steps I should take if I want to explore this captive insurance option?
Get a list of the policies and look at your claims. Look at the premiums that you're paying and look at the claims that the insurance company's paid out.
Okay, so premium versus claims.
Yeah, to see if the juice is worth the squeeze.
Yep. And you're saying then, from what I heard, if your claims are only 50% of what you're paying, then that may be something to look at. If the insurance company is only paying out 50% of what you're paying, that's something to look at in terms of a captive.
Yeah, correct.
Yep. Okay. So that's that's step one, is the juice worth the squeeze based on the policies and the premium and the claims. What's the next step?
Talking to a captive manager, someone that could take the policies that you have, analyze what you have,
right,
and tell you based on your business, these are all the insurances you should have. This is the stuff you should put in your captive, and be able to tell you, because the one thing I've learned over all these years of doing captives is and expert witness work, most people don't understand the insurance policies they have
right,
until they go to file a claim. And at that point, that's when they realize, what, this isn't covered. How many people thought that their business interruption policy would cover viral and bacterial events like COVID?
Yeah, right.
I mean, I think it's widely felt or widely thought by business owners that they would have, this policy, and they went to file and the insurance company said no. Whereas in our captives, we paid out over $50 million from captives back to the business owners that were buying that insurance year after year after year. So they had the money in their own insurance companies, even when their traditional business interruption didn't pay them.
So what if I'm I'm a construction company owner, and, I'm listening to you, Wesley. I'm thinking, dude, I got my broker Dave has been awesome to me. Where do you sit, Wesley, in terms of the broker client relationship?
Well, the good thing is we don't replace relationships.
Okay.
Because we're not selling the product. We would do the analysis and say, go back to broker Dave and say, how much would you save? You could be paying $200,000 for your liability policy with a $10,000 deductible.
Right.
If they were to raise that to $50,000, what does that do? Oh, it drops it by 60%.
Right.
So ask broker Dave to say, we want a quote for this, and we want you to go to the reinsurance marketplace and get this, and this quote.
Right. So step one is to take a look at the list of your policies. Step two is to contact someone like yourself who has experience setting up the captives and take a look at the feasibility of it and get some advice as far as that's concerned.
Correct.
So just so we're clear, who should not be contacting you?
Somebody whose premium is, let's say, below, if all of their insurances are below $250,000.
Okay.
Then a captive doesn't make sense.
Okay.
And I was going to say $100,000, but then I'm like, it's probably $250. But between $100 and $250, there are group captives out there,
right,
that are good solutions. And that's where we would, by looking at the stuff, say, oh, you should be with this one, you should be with that one. Some of them like specific trades over others. You're a plumber, this is a good one. If you're a roofer, this is a good one.
Are you agnostic in terms of group versus single parent captive, or are you just merely it's the right fit for this size of company, whereas if you get to another size of company, the single parent's a better fit for you?
Yeah, we are agnostic, but we're not. I mean, we have our own, basically a series LLC captive structure, which is similar to a rent a captive.
Right.
So those are adequate. I mean, those are great for smaller levels. And it's still, even though it looks, acts, and smells like a group captive, it's a standalone entity that the contractor owns.
Hold on. So just explain that. You said rent a captive. So we've talked about single parent, we've talked about group captives, and now rent a captive. That's a little different. So just define that for us real quick.
Correct. A rent a captive is where you have an admitted insurance company that the business owners pay their premiums into.
Right.
So a group captive, basically everyone pays to the one group.
Right.
And then it's held there in the group, and then they just keep separate accounts and they take from yours, but everyone pays every part of everyone else's claims.
Right.
Where a rent a captive, you pay, let's say, $250,000 to the admitted insurance company,
mm-hmm,
and they take 97.5% of the risk or the money and put it in your own individual Series LLC.
I see. So that would that give you then more control over the risk than the group captive?
Yeah, correct. Because it's at the end of the day, it's your own individual, but you also can control the assets. You can control where that money's invested versus a group where you pay in and then they hold it and then they invest it however they want.
Okay, so then if I'm hearing you right, then you would recommend a rent-a-captive over a group captive?
I would in most circumstances.
Right. And that rent-a-captive then would hold someone, would be good for someone until they get to a certain level that would justify them or make a single parent make more sense.
Correct, exactly. So it's a series LLC. So let's say your business, you pay to the insurance company and then they put it in Series Eric Insurance.
Yep.
You have a separate tax ID. You own 100% of that Series LLC. When you get to a certain size, we just go back to the insurance regulators and say, oh, Series Eric Insurance Company wants to be Eric Insurance. So we would just change it so it's easy to move out, where unlike a group captive we talked about earlier, you have to, they're holding on your money and then you have to go and start a new insurance company. This is just taking it out of the Series LLC structure and boom, it's your own standalone insurance company.
Excellent. All right, Wesley, you've been very generous with your time. We've covered a lot of ground. Where can someone get in touch with you if they'd like to further explore this idea of the captive insurance?
We have a website that I created just around this, and it's www.turnriskintowealth.com. And in there's the ultimate guide to captives, which is 16, 17 pages. But there's also a quiz that they could do that says, oh, you can follow that through and it'll say you're a good candidate, that you should something you should consider doing.
So that's I also have intowealth.com.
Correct.
Yep.
And then I have a book out called Taken Captive, and it's all about captive insurance. Our company's risk management advisors, and all of it can be found at riskmgmtadvisors.com. From there, you can get to my YouTube channels where I have probably 50, 60, 70 videos. I'm coming out with more all the time. I'm doing a lot of videos to just say, hey, this is what's happening. This is the basics of captives. This is how reinsurance works. This is how a sidecar treaty works. So people can go they can start at 101 and they can go 201, 301, 4. I mean, they can really unpeel the onion as deep as they want to go with it.
Beautiful. So all of those links are in the show notes, and you'll be able to contact Wesley through those show notes and be able to check out all of the different resources that he has so you can get comfortable with this idea of a captive insurance approach. Wesley, I really appreciate your time. It looks like you're down in LA. Am I right there?
Yeah, this is right behind me. This is Irvine.
Irvine. Okay. So I like to ask my guests at the end of our interviews, if I'm down in Irvine or that area, what's the one restaurant I need to hit for lunch or dinner?
You know what? You'd have to ask me that, because we just moved our office from Long Beach down to Irvine. And I live in LA in Palos Verdes. So
okay, so then
I'm down here, but Long Beach, there's 555.
Okay.
Newport Beach, there's a ton of restaurants. In Palos Verdes, if you're ever there, there's the Trump golf course. The Trump golf course, Trump National, is right next to where we live, but they have a fabulous restaurant in there. Okay. And then a little place called Primo, which is really good.
And that's in Palos Verdes.
Yeah, correct.
All right, we got the 555 in Long Beach. The Trump golf course has got some good food, and then also the a Primo in Palos Verdes.
Perfect. So on your website, do you have a list of restaurants based by where people are?
You know what? That would be a tremendous idea. I actually don't. So it would be in the show notes of the interviews on my podcast page. So one of these days I should get my my assistant to go through the podcasts and make that list. That is actually not a bad idea, Wesley. I hadn't thought about that.
Because I do a lot of traveling. So we have an office in Honolulu, LA, and New York City.
There you go.
So I'm going to Houston and Las Vegas in the next 3 weeks, and it'd be good. You'd be the go-to.
That's right, man.
Everyone would go there and they're like, oh, I'm going to Houston. I'm going to Eric's restaurant list.
There you go. That's a great idea. You know what? I will definitely keep that in mind. Wesley, I really appreciate you joining us today on Construction Genius. Thank you for being patient with me and just breaking it down. I like to take things simple so that, people can take from the interview what they can. And I really appreciate your time here today.
Oh, thank you so much. I enjoyed it.
Awesome. Today's episode was brought to you by the Construction Conclave. If you as a construction leader would like to develop your skills and get involved in a community of like-minded construction professionals who are focused on building healthy teams, profitable projects, and long-term successful businesses, then the Construction Conclave is for you. It's a private, invitation-only group of construction leaders that are focused on developing their leadership skills. We do training every single month online that looks at how to become a better leader in a very practical, straightforward way. We also have other events that build community and camaraderie so that you can associate with others who are interested in developing their skills as leaders. If you'd like more information and to see if you qualify for participating in the conclave, feel free to reach out to me, eric@ericanderton.com. Thank you for listening to this episode of Construction Genius. Hope you found that 1% of inspiration to help you in the next few days. If you like the show, please give us a 5-star review on iTunes, share it with other construction leaders who you think would benefit, and thanks again for listening.